Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, our program is sponsored by Building Insurance and Risk. Don't put your real estate investment at risk. Work with Building Insurance and Risk and receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Trevor Bacon. Trevor is the CEO of Parcl, a blockchain-based platform that allows users to invest in digital square foot physical real estate in neighborhoods around the world. And in just a minute, we're going to talk with Trevor about utilizing digital real estate as a hedge against inflation. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Trevor Bacon. Welcome to CREPN Radio.
Hey, Darren, thank you for having me. Really excited to be here and appreciate you having us on.
Well, I appreciate you being here, and I'm looking forward to our conversation. Hey, before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, cool. So Parcl was founded in May of 2021 with a group of co-founders. And prior to that, I was an investor in technology companies at several hedge funds. So I was a portfolio manager at two hedge funds and an analyst at one for about 5 years. And before that, I was at several banks, Lazard and Barclays, always within the technology sector. So internet, software, payments was where I specialized. And that's where, I got the deep understanding of both software, which we do a lot of, and blockchain as well.
Got it. So blockchain, can you give kind of a brief description of what it is and how it works with real estate?
Yeah, so a blockchain is effectively just a decentralized ledger that has transactions listed once occurred in a public database. So it's just a public database, not centralized. It's permissionless, which sounds scary, but it's just anyone can use it effectively. There aren't any rules to who can use the blockchain in the traditional system. There's a lot of restrictions. How we use it is probably more relevant. So how we operate, we effectively created two systems. One is a data platform that derives the price per square foot in any given neighborhood, region, state, city of residential real estate. And what happens with you get that price per square foot, for example, if we're Darren, you're in Portland, right? So if we have a Portland price per square foot, that gets piped onto the blockchain. And then we use the blockchain to collateralize that square foot, basically as a financial instrument, and then trade that square foot of Portland on an exchange called a decentralized exchange. But a decentralized exchange is it's just a decentralized version of what any exchange in the world is, which is a centralized exchange. So meaning Morgan Stanley, Goldman Sachs, FTX in crypto, or Coinbase in crypto, that's centralized. A decentralized exchange is where Darren can make markets or provide liquidity without being an institutional market maker. So that's how our system works, which is effectively it's a decentralized exchange to trade real estate prices.
Got it. So basically, Parcl is in like a not the Dow Jones, like the New York Stock Exchange, or it's an exchange where people can go on and they can find different opportunities and trade, buy in and sell. Are you able to
Yeah,
do that?
so right now, the way that the initial implementation is, it is not it's not physical real estate. So the price points are backed by collateral, by someone in the system that says, I think Portland is either going to stay flat or go down. I'm okay putting my Portland shares into a pool to allow people to trade them. If it goes up, I'm on the hook for the loss. If it goes down, I'm in the money. So it effectively creates a two-way market of the price exposure in Oregon or any other place in the country, and then in the future internationally. So think of it much like a derivative index, right? Like you can trade, but it's not very vibrant. The Case-Shiller index on the CME, or like the Mercantile Exchange. The reason why, one theory as to why it's not so vibrant is that it updates every month, but on a 2-month lag. So like financial markets are very efficient. They're pricing in real-time data every minute. And a month is a very long time in markets. So there is a similar instrument. It's just not as robust because of the time lags.
Got it. So back up here one step here. So I have a property and I own it, and it's in Portland. Can I then list it on the and is it Parcel? That's the name of the
Yep.
listing, right? Okay. So can I go to Parcel and list that on the exchange?
No. So in the future, there are various products that would have where we'd be potentially touching the single family, but there's a lot of current infrastructure is not ready to do that, right? You need like the title, you need the loans, you need the appraisals. So again, we are focused more on providing price exposure or providing hedging opportunities with the price movements of the underlying versus actually taking a physical house and putting it onto the blockchain. And that's what's been, there have been instances in which people have tried to give fractionalized ownership or tokenized ownership, another very similar concept, that it does not scale because you actually need to own the house or building and then fractionalize you basically fractionalize who owns it, like you cut up the pieces of the equity. On the other hand, to make a vibrant market in the instance that you're just referenced, you'd have to get a real big buy-in of people listing their homes on the platform to get a good two-way market. So we're starting with this index approach, and in the future, we will likely have or aim to have more call it individualized products. But again, I think that's like some time out because of the financial infrastructure that's needed to make that a reality.
Got it. So it's more of the index model, like you said, as opposed to the physical assets.
Yeah.
Okay.
Yeah, that's how we're starting.
Okay. So back up here a second then. So the blockchain, I get the concept of the ledger and people being able to, you get a token and you can log in, and if you want to sell a part of what you have, if you have one and you want to sell half of, or if you have 10 and you want to sell 5 or whatever that is, you have control of that. I'm assuming that holds true.
Yeah.
So help me understand, then go back to the index. So if I see that Portland real estate is trading for X and I think that it's going to go up, so I buy in. Who is it that holds that, the other side of that investment? Is that you guys? Is that your investors that do that, or how did you guys establish the
two-way?
yeah?
Yeah. So it's basically two sides of the market. One side, like you mentioned, you would just buy Oregon, that would sit in your wallet, that you're the only person who has access to. So we don't have custody of your tokens. The way that it works in in blockchain in a decentralized fashion. It's called a decentralized exchange. So in a traditional market, a bank sits in the middle and makes a market on a stock. Let's say Apple, they have one fund that wants to sell it, one that wants to buy it. Maybe no one wants to buy it, that they want to sell it, so they'll hold it on their balance sheet. And typically they'll take a spread or get a cut for that, right? So in a decentralized fashion, there is no middleman. So what happens is that people will take assets and put them in a pool called a liquidity pool and allow people to trade them. When you allow them to trade them, there's a trading fee, just like the fee that I mentioned for the centralized exchange. And the people who allow them to trade it get their portion of those fees to trade on top. So basically, I'd say I am willing to just make markets, so anyone can make the market. I put Portland token into a pool called the Portland pool. And now anyone can come and trade on the Portland pool. And if they do, I get a fee. Now that can be any single person that provides the liquidity, versus in a traditional model, just the bank would take that to be the facilitator. And that's it. It's just a different model for the same thing, which is a decentralized way to make markets.
Right. So, but I guess what I want to understand is, if you decide to make the market, what does that entail? Is there a capital that you have to
Yes.
put up?
Yep. So basically, if we say Portland is, let's just use $100. It's more than that, but like, let's just say $100 for simplicity's sake. You put $100 into the Portland smart contract. So this is the crux of it, right? So what is backing that $100? It is actually collateral. So it's crypto, but it's not. It's crypto and not real estate, basically. So it is backed by something, and if that goes up, you lose that collateral. Does that make sense? If
Right.
Darren owns it and it's going up, you're losing this collateral, and on the way down, Darren loses the loss to make that person have more money in that contract. So it's a simple contract, a smart contract they call it, where two people are locked into an agreement. If it goes up, one person owes. If it goes down, the other person owes.
So, okay. So you explained how to make a market. How many markets do you have to date?
So we started off, we just entered our alpha stage with our community, which is a closed test. It's the markets that we currently have are Miami, Los Angeles, Manhattan, Brooklyn, Phoenix, and San Francisco. And we'll probably be adding 3 to 5 more in the coming months. And then we are also looking to expand internationally. International data structures are obviously not as they're more fractured, and there's language hurdles we need to overcome, and the various data cataloging there's different rules in different countries. So luckily the US is a pretty large country with one kind of set of data that we can use, but we're very excited about our international rollout.
This is fascinating. So investors, I assume, and what's an average market to establish a market? What kind of a capital or equivalent does it take to create a market? Like if you say you wanted to start Dallas.
Yeah. So we have, so there's ways to incentivize to begin that, kind of the cold start pool of liquidity in Dallas, for example. We have committed capital that are going into the various pools. It's scaling up, and we will, as we enter new markets, follow similar protocol to get capital into the system. You can do that in various ways. You can gate it, you can start slow, you can incentivize people to come in, and then we'll also do our best to release markets that are attractive to users, like try and facilitate demand both organically and then also from us and the community. So trying to take feedback of where people want to get exposure to. If it's Dallas, Austin, Chicago, Paris, we want to know that and then cater to where people want to have their real estate exposure.
So basically, is it a function of whatever you feel like the demand is going to be is how you capitalize it, or how do you?
At the very beginning, you're saying?
Right.
Yeah. So at the very beginning, we'll try and seed markets with some liquidity. So if just the way it works, if you're making a market, for example, and there's a lot of trading volumes, that's a very high return because you're getting fees. So
Right.
if there's a very high return, more people, like economically speaking, more people will come in and provide liquidity, drive that return down. So it is the earlier you are to a liquidity pool, the higher your return will likely be, and that just economically speaking, that gets diminished over time into a more stable rate. And so yeah, so I would say like at scale, like we're kind of when we're open to the broader public, we're looking to have call it like 1 to 2 million at the start in each pool.
Gotcha. And pricing the market, the data that you're using, you mentioned about the lag and that, but I would assume, like I know just a little bit about. I mean, this is almost like IPO kind of stuff from the standpoint of when you start a market,
Yeah,
there's hype
exactly.
and excitement to get into it. Um, so I'm kind of curious on the pricing. Uh, is most of the initial trading just speculative? I mean, because like you said, as a market matures, you get more of a stable thing. Is it? Um, I mean, it's just fascinating to me to think about starting a market, trying to get interest, and recognizing that the majority of um, the return that the investors are getting is based on the transactions. Is that correct? Or, I mean, based on,
Well, there's kind of two sides, but you're nailing the point. So there's two sides. So the person just providing liquidity just cares about the transactions. The
right.
trader or like the investor cares about the price return of the asset. Does that make sense? So like
Sure.
Goldman Sachs or Morgan Stanley, they don't really have a view on what Apple's going to do. They just they want more trades. So
Right.
there's a market maker who just sits there, puts capital there, it's passive income, and they're getting fees. The person trading has a view on the underlying, which they want it to either go up or down. And so there's kind of those two dynamics. But to your point, it is interesting how each market is very much like you are running the gamut of like an equity issuance, right? Like when an IPO comes public, there's only buyers because
Right.
there's no stock to short. The employees can't sell it for 6 months. You can't locate short. So it probably is at the very beginning of very much akin to that. So putting it out, you're going to have a little bit of a off pegness to like the underlying price. And we are facilitating or we're working on different ways to have short, like natural shorting, which would basically be you'd borrow a created, just like a regular stock market where you borrow a stock, sell it, you get the capital, and then you have some margin under it to cover your potential losses plus the returned stock. So we're working on.
Oops. You froze there.
Markets. Oh, that freeze?
Yeah, you froze just for a second. You said you were working on, and then it you went still
Okay.
there.
Sorry. We're working on ways in which to create capital efficient shorting mechanisms. So much like I think you got me on the stock part, but basically you borrow the parcel, sell it, it sits in a contract with the cash and collateral, and then you have to return that whatever the gains are to close out your position.
Got it. And so, is there anything that the market maker, the people that are basically set to, um, incur or I guess charge the fees based on the trades and that, is there anything that prevents them from participating in the market? I mean, one of the things I've kind of come to recognize is that the big money on Wall Street, they make money buying and selling because they recognize the position. I mean, they're big enough to create a position up or down or whatever. Is there anything? Does the blockchain or does Parcel? Is there any, I don't know, guardrails or whatever, or is it transparent as far as who's doing what, or is it? Because I'm just kind of thinking like in an initial market, everything's a buy,
Yep.
and you get to a point where somebody's trying to sell, and if you're the guy that put up the capital and you're basically losing as it goes up, I'm assuming you're waiting for it to go down to make back some of your money based on the yin and the yang of that. Does that make sense?
Yeah. So there are no restrictions with respect to who can use. So the protocol is permissionless. We are being conservative with regulatory regions, like where we're rolling out, just given some lack of transparency in many countries. But broadly speaking, it's permissionless. So if you provided the liquidity, you could also trade if you wanted to. Eventually what we're aiming to do, hopefully in the next several months, is you could also create, like much like a stock market, if you have shares and someone borrows them to short, you can earn return on that too. So it's kind of like your cost to borrow in a regular short market. So we want to be able to create an infrastructure where if you own the Portland parcel, you stake it in a pool such that someone can borrow it and short it. And that's another way to get return in the system and charge fees.
It's fascinating in just the positioning. I think that, if you're a traditional real estate investor, you're thinking about all of the particulars to a particular property. Obviously, it's tied to whatever the market value is or what the market sees and how you believe that you can change the value or increase the value and kind of an exit. Whereas this is kind of fascinating from it's a standpoint of you want to participate in a market, but you're not necessarily, finding a particular property. It's more about an overall market, to appeal to the mass market, meaning that
Yeah.
if you get in and there's a lot of interest, and you get in, you can make make an upside. And I'm assuming just based on the blockchain, there's an easy entry exit from that particular market. So if you got into, say a Dallas when it first started and you wrote it up, you could get out and find another market and get in.
Yeah, exactly. Yeah,
So
the goal, it's like a liquid exposure, obviously in hard assets, right? Like a lot of the opportunity is buying it at the right price, fix it, or however you can ride the neighborhood demographic, it changes. And if you think that's good from an economic standpoint, you could also do work and then flip it to get return, right? Obviously, those are great ways to invest and earn return. In this specific type of instantiation of real estate, it's more like you can trade these same kind of economic shifts in the areas. Eventually, we want to have leverage, so it's not so dissimilar from actually, it's not as much of a binary. Like, I think real estate's great because you can take leverage and those returns are levered. You could do that here as well, and then have immediate liquidity when you want to sell and kind of rotate into a different region if you think it's petered out. You'd also be able to short, so you'd have relative value. I like Portland and I don't like San Francisco, and you could play that trade. So it's you can see kind of traditional Wall Street structures being formed around the real estate price action.
So how directly correlated or coupled is the physical asset, that market, to Parcel and in the digital market? If I mean, obviously when you price it to begin with, I would assume you're trying to mirror what the actual market is.
Yep.
But if you have, speculation just because of parcel being something new and people can get in and get out and they run the price up, but yet the actual physical asset's not necessarily in the same,
Yep.
the ability to run something up or down
Yeah.
is not as instant. Um, is there any kind of a correlating factor? Or is it basically just buyers and sellers in a marketplace?
Yeah, so there's something that we call the peg. So the peg is the price at which, if we're gonna go back to the stocks, but it's kind of like the issuance. So
Mhm.
you collateralize it at the peg. The peg is a representative price of on the ground real estate today. It updates every day. So imagine a more robust index that is taking into account various obviously publicly available data, but to get you to a representative price per square foot, and that's like the parcel price. So you can always mint and create assets at that price. There's various ways in which to drive the price down. You can mint and sell. You could mint and provide liquidity and add liquidity around certain price points. And then, yeah, so we do anticipate that initially, as these markets do get off the ground, you'll have some floating away from that price. But I think that's similar to most markets, right? Again, if we started with just one stock, for example, you're issuing it, it'll deviate from like the intrinsic value just simply because of the imbalance of buyers and sellers. We are working on different ways in which to create more fluid systems to have that natural balance. And then over time, it becomes hopefully an efficient market. So this is the price, right? We have our reference price. You can issue at that price. But if we can create a creative market with enough liquidity and enough selling and buying, that becomes the price, and it can be off peg because it's a smart market. And that over time can actually inform on the ground decisions with respect to pricing transactions, and other types of real estate data outlets.
Got it. So if I understood right now you're basically in a beta mode, or is this active, or
Yeah,
can
it's
people?
active and live. It's
Okay.
on the Solana blockchain. We are in basically we call it an alpha, but for all intents and purposes, it's a closed beta, where we have like a small subset of users trading real dollars. We're super thrilled with the initial momentum, and we'll be opening it up over the coming weeks to just a broader set of users.
I think it's fascinating. Just one of the things I love about the digital age is just, all of the opportunities and people like yourselves that are creating, opportunities that previously had not been. It's incredible. So as far as like investing in a physical asset, you have the opportunity, like you said, if there's leverage, you've got some interest write off and depreciation, some tax advantage kind of things. I'm assuming that's not necessarily the case with this. Am I missing that, or is there any correlation or
Yeah.
opportunity?
Not right now. I do think there's various ways in which you could tax loss harvest on if you were to be really savvy with respect to if you were okay being short or taking a loss in this vein, as to tax loss harvest your view on the market, right? Like you can't your house can't do that for you. So
Right.
there are different there's savvy ways to do it. But for the kind of the natural flow, there today there's not. In the future, the regulation is pretty the framework for digital assets has yet to be truly developed. So we hope that we can help influence that. And I think hopefully we can figure out a way in which to have that as part of the future. I do think, generally speaking, institutions are buying more houses, making it harder for the younger generation to actually participate. So just because they can't participate, that kind of weeds them out, right? They're excluded. Today, actually, Blackstone, I'm pretty sure it was Blackstone, announced that they were raising a fund to buy 1 million houses a year. There's a shortage of houses in the country. So now all of a sudden, you're pretty much either stuck renting from Blackstone and institutions, which means you're short real estate, right? Because when prices go up, you pay more rent. So it's falling on the consumer, especially the younger consumers. So, I think for equity or inclusion, having ways in which other people can participate in real estate, such as this, but also get those structural benefits that traditional real estate offers, which is tax write-offs, depreciation, etc., should be considered by policymakers, I think.
No, agreed. So, what was the first market you guys opened in?
So we launched in 6 total: Miami, Brooklyn, Manhattan, San Francisco, Phoenix, and Los Angeles.
And how long have you been live?
1 week.
Oh, really? So this
Yeah.
right? Okay.
Yeah.
Wow,
Well,
fascinating.
the live, so we've been developing this for over a year. So it's taken a lot for us to get to where
Sure.
we are.
Oh, yeah,
So
yeah.
we've done 3 test nets with what they're like fake dollars. Now we're live with real transactions, and that unveils a new set of opportunities and things to deal with. But we're very pleased with how it's evolving.
So I'm curious, the test dollars where it's not real money as opposed to the now you're live and it's real money. Do the two scenarios, do they track, or are you finding that behavior is slightly different with real money?
We didn't gate means like we didn't close the test net to a subset of people. So really we're dealing with like 100 to 200 people, which is where, and that's like our community that we've been building over the last 6 or so months. So those are like our patient users. They can tell you when something's not working. They can they can call you out if on Twitter if something is broken. So I think some of the behaviors that we're finding are Brooklyn, like some of the smaller demographic areas, like Brooklyn is a hit. Miami, Phoenix, like these areas are pretty high in demand. Again, it's a small sample size, so we need to understand exactly what's driving that. But we'll do more testing to figure out like what exactly is behind some of the demand drivers, and then keep catering to those specific products.
Yeah, no, it's fascinating. Again, just the concept and the application, and just I hadn't even thought about how social media, Twitter. If you're being attacked on Twitter, or not even attacked, but I mean, just there's a lot of talk on the social media that would attract and provide movement or opportunity for movement in a market. I mean, to me, that's fascinating. It kind of reminds me of my son, gamer. He was all excited about GameStop back when,
Oh,
I was like,
yeah, exactly.
look at the fundamentals, everybody. That's,
Yeah.
but no, fascinating. Hey, Trevor, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when neither avoid nor minimize are options, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be their clients, investors, the market, political, social media, whatever you consider to be the biggest risk. And just again, identify it and then explain why you consider it to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer.
Yep.
And so if you're willing, I'd like to ask you, Trevor Bacon, what is the biggest risk?
Great question. Aside from the table stakes, which is just execution that we're focused on every day, I think security and transparency is something that we take very seriously, and we obviously identify that as a risk point, both for the actual product, but also for our community and reputation. So we take security on both the data side and the blockchain side very, very seriously. We've had multiple audits. We have audit firms on retainer to make sure that every line of code is audited before we put it on the blockchain and expose it. So that is something that we view as a risk. We do our best to manage it and, as you say, mitigate it through checks, protocols, just time spent in development. And then that's something that we'll continue to make more robust as we expand.
No, it's fascinating. And again, just the risk you face and what you have to do to control them. That's great.
Yeah, this is an industry. That question is it's very applicable to crypto, generally speaking, and blockchain. So we're basically you'd have a field day here.
Oh no, I'm sure just cyber and just between what you're the product you're creating, which is essentially the code so that the users can interact, and just to be aware of all of the things you got going. There's a lot of balls in the air there, so that's great.
Yeah.
So, hey Trevor, where can the listeners go if they'd like to learn more or connect with you?
Yes, we'd love to connect. Twitter is our main medium. It's Parcl, at Parcl, Parcl. It's a verified account, so there may be others, but that's the one. You can find us at Parcl, Parcl.co. Our app is app.parcl.co. And we're also on Discord. Just search for Parcl in the Discord app. So we'd love to hear from you and get your feedback.
Awesome. Well, Trevor, I can't say thanks enough for taking the time to talk today. I've thoroughly enjoyed our conversation, learned a lot, and look forward to doing it again soon.
Darren, thanks a lot for having us. We really appreciate it, and thanks for all the insightful questions.
Oh, my pleasure. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.